All right, bulls kept it interesting with a nice bid throughout the session. It was kind of the bare minimum and within the framework that I laid out. I was actually surprised yesterday we didn't firm up even better because with inflation, the only thing on the docket, a little break from the tech earnings, which have been negative, today seemed like the opportunity for stocks to get a bid. Especially when you take the context of the economic data for the week, which was pretty good stuff. It was a pretty darn good week for economic data. Might have slipped through the discussion because of all the earnings focus, but that's an important part of the framework that I've had on my risk radar, which is the yellow light on the dollar despite the green light on bonds. We continue to see strength in treasuries around cooling inflation, but also the decent GDP read and the overall consistency of the rest of the data. Even though it's worsened over the last quarter, at least it's kind of slowed down its negative surprises. So that was important here. We started surprising a little bit more positively on the data, so the dollar held in. Now, that helps the stock market in the rotation mode because it gives some good credence for the stuff we've been rotating into, but it doesn't solve the problem of tech. That's why the red light's still on, because bears still have the edge after this week. Obviously, the performance was net negative, but the fact that we also stayed today within yesterday's range, it was good that we didn't touch the lows, but it's also a problem that we're kind of stuck under old support. It might be becoming new resistance. I'm talking about basically that 55 area that we went through and broke down. That's what was painful this week. And then we traded the last 2 days basically below that. That's where we were throughout June. So now that you're dealing with potential resistance right above, you really can't be super hopeful until we get through 55. So that's the job of the market early next week, is to get S&Ps through 55 to set a more even plate going into our big giant tech earnings. And boy, are they important, because they still are dragging us. The performance over the last roughly 2 weeks since July 10th, you're going to see a lot of my charts get zeroed out to July 10th because that's when CPI came in light. Value is really the only thing that's still working. The companies that were beaten down and forgotten over the years that have some decent fundamentals holding in very well. What's important here this week is that the high beta trade did get dragged down. Initially, when CPI came in light, the high beta trade, that's the riskier stuff, the companies that really depend on the economy, the stuff a lot of times that doesn't even have any profits, the kind of gambly stuff out there, the high beta trade, that's now negative since we started the rotation. Of course, growth generally getting slammed. And the problem, the really big one, is that the higher quality tech companies with the reliable balance sheets, of course, are negative too. So you've really only got one trade working, and that's kind of the higher quality value trade in the market. At the same time, though, there is a very difficult challenge in the overall narrative tied to this rotation because it requires the economy to hold in. And the other messages being sent are that we're generally in that kind of late cycle. The look at the dollar holding up here tells us it's September. There's no July. Get that out of your head, okay? Powell's going to start to set the table, it looks like, next month for the September cuts. The dollar holding in at 104 tells us again that nothing changed on the expectation for the Fed, despite so many people over the last week crying for a July cut since the inflation came in like cut. Well, you hit a 2.8% GDP and the inflation still above the Fed's target. You're going to wait according to the timeline that looks the most appropriate, and that's September. So the dollar tells us that September holds in, which might mean we still have a little stress on the economy. We might still be pinching here at a point that's generally historically indicative of a deeper rollover, and that's when the yield curve uninverts. It's the last chart because the 2-year yield is dropping like a rock, but so is the 10-year yield as well. It's not obvious if we're cutting because the inflation is worth celebrating how far it's come down, or if we're cutting because the economy is slowing down. Right now, it's basically an even mix of both. And that's where the trade could still go both ways. But with tech valuations where they are, the net move here still is in favor of the bears going into next week until we get above 5,500 or get any indication that the data are really going to firm up and we can get that miraculous landing. But I still think this is a market rotating, trying to bet on a miraculous landing when the odds are still at best 50-50 and tech's an issue and too expensive still. Have a great weekend.